S&P 500 Index, SPX, long-term chart analysis. The S&P 500 Index, SPX, continues to exhibit strength as we approach the end of the year. Last week, we observed a rally of plus 1.06%, suggesting that the anticipated Christmas rally might be underway. This week, the index has rallied once again, with a gain of plus 0.96%, further solidifying the presence of the Christmas rally. The SPX has hit a new all-time high, reinforcing the bullish sentiment in the market. The conservative and aggressive strategies. The conservative S&P 500 strategy is crafted to shield investors from bear markets, enduring short-term declines without triggering sell signals. This strategy is grounded in long-term chart analysis and remains unaffected by emotions and news events. It is designed to accommodate market fluctuations without attempting to time every minor movement. Investors are encouraged to maintain a long-term perspective. On the other hand, the aggressive strategy closely follows short-term indicators for those inclined towards more active trading. Currently, we maintain a bullish position in the RIDEX S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs such as SPY. S&P 500 Index, SPX, and current chart analysis. At a recent Dallas Regional Chamber event, Fed Chair Jerome Powell highlighted the robust economic growth, allowing policymakers to adopt a cautious stance in deciding interest rate cuts. This backdrop has supported the ongoing rally in the SPX. The NYSE advanced decline line is at all-time highs, reflecting the strength of the broader market. While some internal indicators are showing overbought conditions, the market adage overbought does not mean sell holds true. Markets can remain overbought for extended periods without indicating a sell signal. On the SPX chart, support is identified at 6,010, the most recent resistance level, with stronger support below at 5,870. The bullish momentum is further supported by the fact that new highs on the NYSE continue to outnumber new lows daily. This bullish indicator would only change if new lows were to surpass new highs for 2 consecutive days on the NYSE. Market internals and economic indicators. The market internals revealed that 67.91% of stocks are trading above their 200-day average lines, leaving 32.09% of NYSE stocks below this benchmark. This is a positive indicator of market strength. Several key economic reports were released this week, providing insights into the broader economic environment. The Logistics Managers Index, LMI, in the U.S. recorded a value of 58.4 in November 2024, slightly down from October's 58.9. This marks the 12th consecutive month of growth, indicating a steady recovery in the logistics sector, contrasting with past sudden spikes driven by external shocks. The number of job openings in the U.S. increased by 372,000 to 7.744 million in October, surpassing expectations of 7.48 million. Job openings rose in sectors such as professional and business services, accommodation and food services, and information, while federal government job openings decreased. The number of hires and total separations remained stable at 5.3 million. The trade deficit in the U.S. narrowed to $73.8 billion in October 2024 from an upwardly revised $83.8 billion gap in September, against forecasts of a $75 billion shortfall. Exports declined by 1.6% to $265.7 billion due to lower sales across various categories, including industrial supplies and materials, consumer goods, and vehicles. U.S. initial jobless claims rose to 224,000 for the week ending November 30th, up from 213,000 the previous week, exceeding market expectations of 215,000. Despite this increase, the data suggests that the U.S. labor market remains robust, providing the Federal Reserve with the flexibility to slow the pace of monetary loosening should inflation persist. The average rate on a 30-year fixed mortgage eased to 6.69% as of December 5, 2024, marking the lowest level since mid-October. This decline aligns with Fed funds futures, reflecting a growing market consensus for a potential rate cut this month. Conclusion. The SPX position in this strategy remains bullish. Aggressive traders should consider positions in the RIDEX Nova S&P 500 fund RYNVX or other bullish S&P 500 index funds or ETFs such as SPY. As we move towards the new year, the odds favor higher highs, supported by strong market breadth and positive economic indicators.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.